We are back to close out another week in the markets. It's going to be a red one in TradFi. Looks like has the potential to be a fourth losing week in a row in crypto. We're going to be talking about that, the housing crisis in Canada, and more today on Money Never Sleeps. Welcome back, everybody. As we get going today, hit that like button down below, subscribe to our channel. Nothing that Kevin or I say is financial advice. Please do your own research before making any buys or sells. Kev, so far it's a pretty boring day in the markets. TradFi is flat. We're seeing between 0.03% and up 0.4% movement over there. Not a lot going on. The VIX is down. The dollar is flat. It's really boring out there today. Crypto continues to be slightly down. As I mentioned, this is going to be the fourth unless something changes before the weekly close on Sunday. This is going to be the fourth losing week in a row for crypto. That's the longest losing streak since the middle of last year. Actually, I went back and looked through that. We haven't had a 4-week losing streak for total crypto market cap since let's see, about April, May of last year. So it's not huge losses the last 3 weeks, but we're just like slowly trending down. Very little strength. Not a lot of people looking to buy at these levels. And all it takes is that one shining moment to send it all crumbling down.
Yeah. Fucking shitty, right? Again, that just shows you how this market's been extremely resilient since. 4 weeks, even though it's not substantial, it's still 4 weeks of losing, right? And that could be at a point where I think a lot of people are starting to get I don't know, I guess restless or hopeless that this market's going to go up from here. And it's just really interesting. Again, I think this, we're in a really fragile state. I've said that before, and I think that some people are starting to realize that. But I think, going into October, once, a lot of these debts come due, might be even a little bit more bleak for some of these markets. You know what? Yes.
Yep, for sure.
Crumbling down.
We have, like you said, the student loan payments are coming back. People are running out of savings. The holidays are around the corner.
Gas is going up soon.
Gas is going up. Inflation is going to start to pick back up, we think. We strongly believe. And that just is not good for people who are holding risk assets. When it comes time to pay the piper, are they going to be like, you know what, I want to continue to hold my Shiba Inu coin, or do I want to pay my bills? Probably should go ahead and pay my bills. So it's a touchy time if you're still overly bullish on the near term. Okay, like the next 6 months, I'm once again just so over all of these fuckwits who are like, you're an idiot if you're bearish right now. How could you be bearish on this technology? Blah, blah, blah. It's like, dude, do you not understand the difference between like near-term, mid-term, and long-term investments? Like, it's not the same thing at all. Like, these time horizons are very different, and you need to view them as such. So I think there's just so many reasons to be bullish long-term, but I haven't changed anything short-term. So let's see. We have that as well. There are a lot, we have this huge potential hurricane. We have continued escalation in Asia. We don't know if there's going to be more escalation in Ukraine. Like, it's a really, all it takes, man, is just one of these things to happen, and it's a cascading effect.
I will say this. Again, I was telling you right before the show, I read that U.S., Romania, and Ukraine and a bunch of other nations on the Black Sea are going to start doing some exercises in there, military exercises.
Run wind sprints, or
I think they're doing some competitive rowing.
Fitness test.
They're just going to go around the boats, just try and go from north to south. But No, I don't even know if that joke sucked, but I was trying to be funny. I suck. But the funny thing is that we're getting more of these escalation stories. You know, these headlines that are popping up. The deeper we get and the closer we get to what we anticipate being the financial collapse, right? And this is kind of this thing that I've been saying. They have to cover it up in some way because, again, if the global economy collapses because of someone that they can blame, then they have all the will in the world to pretty much get away with everything that they've done and get away with pretty much what happened in 2008, right? People got greedy. We saw definitely some insider trading and shit like that. But it just kind of plays into this narrative that, okay, inflation's probably going to spike up again. And that's the perfect way for them to let the markets drop, right? I think a lot of people are getting out of their positions right now. That's why we haven't seen crypto tank, even though it's bounced off that 25.28. And we've seen the market, it's been, going up a little bit, but as soon as it gets up there, they sell it off. So I think a lot of people are getting out of their positions. And this might be one of those things where it's like, okay, now we can kind of let this fall because then we have an excuse for it to fall.
Yeah, for sure. I'm wondering, did you see that North Korea allegedly was behind the hack of the sports betting site Stake? Yeah, like 41 billion. I'm wondering if that was just they're running out of money to buy more missiles that they're shooting off into the ocean. So they had to go hack a sports betting site. But
you know who's tied up with them apparently? And the US is after them?
Who?
Binance. Binance apparently allowed Lazarus, which is I think the terrorist organization,
to
what he caught, offload some money. So
oh my God.
Not saying anything, but it's all tied, guys.
This is all hearsay. Nothing is factual. If anyone from Lazarus is listening, please do not hack me. My family cannot afford that right now. Anyway, let's get into some of the news at this point. Very little has changed lately. There hasn't been a ton of economic data. We have had Fed speakers this week, and that's something I talked about at the beginning of the week. All of these Fed speakers, and the recurring theme has been most of them are thinking that this soft landing is coming and that we might have one more small rate hike this year. That has been, we're at the point where it's confirmed basically that no hike in September. I have a hard time thinking that the inflation number have to be unbelievably bad for us to get a rate hike. However, the November probabilities have stayed the same, a 44% chance that they hike again. 46.5% chance that they hike again. So, it's still out there. It will be data dependent for end of September, all of October, blah, blah, blah. But it's the rosy picture that they're starting to paint and that we're seeing Bloomberg and other publications run with. I think it might get people into a false sense of security, not realizing that even if they don't have to hike again, there's still a crash is still coming at some point. Like historically, we've seen it after pivots have happened. Maybe these days, with information flowing quicker, maybe the crash comes sooner because more people are preparing for that. But something is coming. It's only a matter of time. And there's a reason that, I saw NVIDIA CEO Jensen Huang sold like $44 million worth of NVIDIA stock. There's a reason people are sitting on mountains of cash. The smartest institutions in the world, the banks who have the best analysts, a lot of these investment, hedge funds who have great analysts, there's a reason they're continuing to be bullish. Meanwhile, Slapdick over here on Twitter is like, if you're a bear, you're an idiot, blah, blah, blah. I'll go ahead, and you don't have to like the banks to know that they're going to be smarter than your Twitter influencer. I'm just going to leave it at that.
I don't know, man. Slapdick's got a PhD in slapdickonomics, but this is
vibe definitely session, baby.
Vibe session. Yeah, what the fuck happened to that, right? I'm not even gonna get into it, but pretty much all the data that they said that wasn't fake turned out to be fucking cooked because all the jobs data for the past 6 months has been completely BS. Besides the point, I will say this though, to the point of Jerome Powell maybe not acting fast enough. Again, another reason why maybe Donald Trump doesn't want to, renew his position as Federal Reserve, president. Probably, maybe this. I mean, he has acted pretty slow. He started off pretty slow raising rates. Maybe he's a little too slow to cut them. it's a good chance that the crash could happen before. I believe, I think it was in 2008, once the market did start to turn from the top, Bernanke cut after the top, whereas in Greenspan's case back in 2000, when the dot-com bubble happened, he cut rates right at the top of the market. So we'll see how it plays out this time. I think we're already past the top of the market in Powell's case. So I don't know. Maybe next week's supposed to be a really big week. There's a lot of stuff coming out. I wouldn't be surprised if we start seeing a bit of the truth coming out next week. That's just me being facetious, though.
Absolutely. Ace, good to see you, buddy. Chris, also didn't thank you for being here. Ace,
Thanks, guys.
Good to catch up. Let's talk a little bit about what is on the horizon next week. We're out of earnings season pretty much all the way, and now we have a focus once again on economic data. There wasn't a ton this week. Next week, though, it's CPI time. Wednesday, consumer price index, core consumer price index. Thursday, producer price index, core producer price index, retail sales, jobless claims. We're going to have some data. It's going to be the last little bit before FOMC, but I am anxiously watching that data based on the fact that we have seen continued, Brent and WTI took a little break yesterday on the oil side, but they're back on their way up today. Brent approaching 91 a barrel, WTI at 87, around 87 and a quarter a barrel. So there's definitely the energy trade, natural gas is back to like 670 after taking a little bit of a tumble. The energy trade is still in play. I'm still holding a very large position in natural gas. I'm not panicking yet. I have my targets. I have my exit points. And I firmly believe I'm going to get to hit those.
Dude, we had the bottom in that oil trade. When you and I were talking about it back in March, it was trading at $64 a barrel. The lowest it went was $63. We literally had the bottom of the oil trade. We should have just fucking had like 13x, 15x leverage. But natural gas, again, that's we talked about it when it went to $8 too, just to bring it up, that there was a lot of gaps below. So we thought that maybe there would have been a pullback. Well, pulled back, it hit the biggest gap, and now it looks like it's ready to be trading within that range. Maybe you can break out of it. It's like in a megaphone pattern down there. So I'm still confident in natural gas too. Again, with all the news coming out of Ukraine and Europe, there's a lot of issues that we're getting here, even in the U.S. when it comes to the energy crisis. So I still think that the energy is just as good as gold at this point. Again, I'm not saying actual gold the asset, but I'm saying that it's a pretty I think it's pretty lucrative. Again, I'm looking to get back into natural gas, but right now my position is 100% in shorting these fucking banks.
My ideal situation would be I'm able to sell in like the very beginning of January if it gets up near there, because I don't need to worry about the taxes until the following year. Nice. And I have enough taxes from NVIDIA and some other stuff this year that I don't really want to add to that. So that would be, listen, if it spikes before then, I'll take it and I'll go with it. But ideally, please, if there is whoever's listening up there, like, give me a good price on natural gas to exit early January, so then I can just take it and run. But let's talk a little bit about the Canadian housing market. This was a subject that you brought up to me. You've done a ton of research on. I began looking into it. Much like here, there is a huge crunch on housing, particularly affordable housing. There have been a lot of fingers pointed toward immigrants, toward international students coming to Canada. All of that seems like it's just some disingenuous talking points that have been dispelled by people who actually know what they're talking about there. However, for our purposes, we're not here for the socioeconomic and political talk of Canada. We're here for how that's impacting markets globally, how it's impacting those markets, and if there's an opportunity presented to us. And I want you to lead the charge on that one, Kev.
Oh, yeah, absolutely. So, yeah, the reason I saw this on Twitter, someone was talking about negative amortization. And then I looked deeper into it. And I think the main reason I wanted to bring up this today is because this goes back to the banks, and the banks are the main issue. I've seen both in the US, Canada, internationally, I think that there's a lot of people who have extremely unrealized losses. We'll talk about US Bank later. That's another one that came up. But we're going to talk about Canada and their entire situation where they currently sit. So the first thing I do want to bring up is Canada's unemployment rate. So Canada's unemployment rate's been pretty stagnant. So I'm going to pull up this chart here. And we can see that in August of 2023, we're at about 5.5%. It's been rising, but at the same time, unemployment's been fairly stagnant since October of 2022. Let's go to a 5-year lookout. And again, this is the pandemic, so that's skewed a little bit there. But it's been rising, and it's getting closer to that 6%, and it hasn't shown any signs of stopping. And the reason this is an issue is because this affects a lot of people who have mortgages or pull down mortgages, and how are they going to pay them, right? And in Canada, refinancing your mortgages comes up about every 5 years or so. So you can either get a fixed rate or a variable rate. And this is where it's been kind of an issue. So now you have unemployment rising in Canada, but at the same time, rates have also increased in Canada to, I believe, like 4.5%. They've been pausing. They recently just paused. They didn't raise rates once again, but this is not good because that means a lot of people who are refinancing or have variable rates are getting screwed on this. And the reason you would take out a variable rate versus a fixed rate is because, the payment that you'd pay each month would be considerably lower. But as rates increase and the amount that people are paying off, we start to see this thing called negative amortization, which is pretty much very similar to when you pay off your credit card. The interest is starting to become more of your payment that you're putting off. So you're not necessarily paying off the premium, or you're not paying off not the premium, the principal of the payment that's due. And this is coming up with mortgages to the point where some of these negative amortization things are negative amortization is delaying how long it takes you to pay off your houses. And banks in Canada have seen anywhere from 60 to 65 years to pay off your house because they're just not paying off the interest fast enough. Therefore, the principal on the mortgage remains extremely high. You're not paying off anything. So it's a really big problem. And again, it's a bigger problem as unemployment continues to rise in Canada. And if you've kept an eye on, or again, that's kind of it's kind of a weird situation in Canada because prices have gone up pretty significantly since like the 80s. Everything in Canada is pretty inflated in terms of housing. We saw that in last year, it kind of dropped a little bit, but for the most part, it's been very bad in Canada for housing in terms of prices. And now we're starting to see, these rates have a pretty big effect on consumers and residential properties. So I do want to pull up this. This is borrowers of TD, BMO, and CIBC. They see their mortgages balloon due to sharp rise in interest rates. I just want to look at some of these numbers because they're absolutely insane. These are 3 major Canadian banks. They've disclosed about 20% of their residential mortgage borrowers. We can see down here that BMO has about 32.8 billion negatively amortizing, which is about 22% of all their loans at their bank and mortgages. We see that TD, Toronto Dominion, has about 45.7 billion negatively amortized. I can't even say this. Amortizing. It's such a weird word, but pretty much that they're not paying off they're paying off the interest and not the principal, and that's accounting for roughly about 16 or so percent, 18% of residential. And then we could also see that there's other ones down here too. There's certain BMO and TD disclosed that after CIBC started reporting negatively amortizing loans in the fiscal fourth quarter of last year, they've had 49.8 billion, about 19% of the Canadian residential loan book. So there's a huge amount that are negatively amortizing. And in some instances, there are people that believe that this number is a lot closer to 30%. This is just what they're reporting here. I would be surprised if that's the case too, because again, we're going to try, the government and a lot of these banks are going to try and make it look a lot better than it currently is. And this is the best part too. They asked some of these representatives what they thought how is this going to affect the banks and the mortgages. They said that it's within some of their models, which is very funny because that's exactly what some of the credit rating agencies back in 2008 also said. And then for others, they didn't even comment on the situation. So it seems like there is a bit of stress here on the banks themselves. We're going to take a look at some of these bank stocks too, because there is an opportunity, I think, to short some of these because a lot of them haven't necessarily seen as much pain as other bank stocks that we've seen in the US. So there might be an opportunity there. Again, I haven't gotten into them. I'll let you guys know if I do get into any of those positions, but there's some that I think are very interesting. So now that we know what's going on in Canada, the mortgages are going up. The interest on those are going up because people are using these variable rates and the rates continue to rise. Every 5 years or so, they get to refinance those. And we're seeing that a lot of Canadians are having less income due to unemployment rising. So it's an absolute clusterfuck and it's all working together. And now people say that some of these banks are too big to fail in Canada. And it's possible, right? I don't think a lot of banks will fail, the big ones. The question is, do some of the ones that have some of these loans that are smaller than them get bought out by some of these bigger banks, right? It's a matter of liquidity and seeing who is solvent at the end of the day when they have to report, whether it's corporate taxes or, they have to operate. If their operating income is more than what they actually have, game over for a lot of these guys. But I do want to pull up some of the banks that are, top mortgage lenders in Canada. Let me see if I can find it right here. Canada unemployment rates, no. Borrowers, there it is. 10 best mortgage lenders in Canada. First off, we got Royal Bank of Canada. They have about $311 billion worth of residential mortgages. You got Toronto Dominion Bank, $280 billion worth of residential. Bank of Nova Scotia, 269. BMO's down here at 140. We got a couple of other ones down here. HSBC of Canada, 23 billion. So there's a lot of money in residential mortgages that are currently here. And if we're accounting for some of these companies having, 20% of, the residential mortgages being, negatively amortized and these people aren't paying off anything on the premiums, then, we're kind of just in this, zone where, okay, they're keeping their head above water, but if the rates continue to rise, are these people going to be able to pay off even the interest in full that's due? It's really dangerous. And these banks, I think, are the ones that might be the most exposed to consumers who are just unable to pay. So these are the ones that I'm keeping an eye on. And I just wanted to pull up one last thing here before we look at some of these charts. Is these are the top 34 banks. Again, we talked about this a while ago. This is pretty much how we were able to, identify a lot of these that are been borrowing extremely, from banks like the Federal Home Loan Bank, the BTFP program. But if we look at Toronto Dominion, which has a lot of these loans, they are, where did I put them? They're on this list. They are, maybe it's over here. I should have highlighted it. But the ones where it was BMO Harris is on here, which we can see right here. BMO should be in yellow. There it is. BMO's in yellow. We can see that they borrowed, $2.5 billion or so from FHLB. Again, they are a pretty big whale bank. They have 70% or more of all their deposits over 250,000. So that's not necessarily a lot of people who are, residential, but they definitely have exposure to a lot of these people who do have, some of these mortgages. And then we wanted to take a look at TD, which right here, it's in pink. There it is. They have 22% of FHLB as equity, and they have 9.5 billion or so when we look at how much they borrowed from the FHLB. So a lot of these are still overexposed. They've pretty much fit the mold. The ones that we were seeing on there are on here as well. Again, that's because these are also in the US, but there is exposure both to the US and the Canadian markets when it comes to some of these residential mortgages. And it does not look like this is going to be something that plays out in real time with a lot of the other things that are going on. I think that if we see unemployment continue to rise and we start to see a drop in the equity market, then there's a good chance that people stop paying off. And again, we know that delinquencies are on the rise too. They're probably rising like crazy over there, just as they are here. And we're seeing that a lot of people are not only, being delinquent on payments for their homes, but they're also being delinquent on their payments for vehicles and whatnot. So a lot of their assets are actually becoming debt. That is not a good thing. And that's honestly adds to what this whole credit event is really about, right? It's about debt.
All right. Let's look at some of these charts.
Yeah.
And we should definitely, I think it would behoove us, Kev, if you just had like we were able to quickly, and maybe you can have Mr. House help us with this, but put this out on Twitter too, because I think that's good information that people would be interested to see. But let's look at a few of these banks, the ones that you think, not financial advice once again, but the ones you think are most susceptible to getting their asses kicked. I believe that's the technical and professional way to say it. What are the ones that you have your most attention on?
For those who get their asses kicked, I do want to pull up the biggest one that was on that list as the top borrower or lender of mortgages. This is Royal Bank of Canada, and they had $300 billion worth of residential mortgages. The reason I pulled this up is because this is one that, while we have seen volatility in the markets, it hasn't been as bad as some of the others. And we can see that right now it's just kissing. It's literally licking the shoes of the 200 EMA. And I think that if we start to see a bit of a downturn, this thing's going to go bad, and we see that 50 is right above it on the weekly. That's not I mean, again, I'm not going to pull up the video because it hasn't happened yet, but the death cross, is very possible. We can see that the 50s, as long as we keep closing below the 50 moving average over here, there's a good chance that this is going to continue to climb down. 200 is going to stay here, and if we start losing this as support, it's not a good sign. Just look at the monthly real quick too. It's right there on the 50 moving average. I know it's completely oversold on the monthly here on the stochastic RSI, but when I look at this, there's a lot of support it's hanging on to, and that's not necessarily a good thing to see if, again, we think that it is the most exposed to residential mortgages. So we'll keep an eye on this one, but I do want to pull up Toronto Dominion, which is TD, and we're going to look at the Toronto Stock Exchange here for this one. You can see that we're starting to close the monthly underneath the 50 moving average, right? So naturally, you would anticipate it to test the 200 EMA if this weren't to hold support. And let's look at the weekly. Weekly, you can see that it's coming down. It's already closing below the 50 and the 200. And look at that. We're going to be playing that death cross video very soon on this one, in my opinion. And even looking at this over here, I mean, I just noticed this right here. Let's see, do I have it? Oh, no, where did I put it? Is it here? Head and shoulders. There it is, head and shoulders. Oop. 1, 2, 3, 4, 5. Head and shoulders pattern right there. So, yeah, I anticipate this probably is going to break. Again, looking at that, I'm not saying it's going to, but if it walks like a duck and sounds like a duck, it's probably a duck. This right here is just hanging on to these moving averages, and a lot of these things are hanging on here. Toronto Dominion is TD, also known from TD Ameritrade, which you also know there's a lot of issues there with Charles Schwab, which I personally do have a position in because I think Schwab is a bit overexposed at the moment. We'll see if anything comes of that. Again, not financial advice, just keep an eye on how a lot of these things are, interconnected with one another, but this looks like a head and shoulders better to me on the weekly. There's definitely room to come to the downside, and if we look down here below this level, it's not a lot of support, guys. Maybe 57, if you're lucky, maybe around 67, but from where it currently is, that's about a $13 drop. If it does want to come down to this 57 level right down here, that's about a $23 drop. So we'll keep an eye on that. Last one I do want to pull up is BMO, because this is another one that I do have a position in. We can look at this on this is the Canadian. So the Canadian version of BMO's chart. This is on Toronto Stock Exchange. I'm obviously US, but it's a similar situation, right? We got the 50 and the 200. They're getting closer and closer to each other. We're finding resistance now on the 200 EMA, which is not good on the weekly. If we look at the monthly, right now we're below the 50 moving average. Again, what would be natural? Probably to test this 200 down here. I am going to pull BMO on the American exchange too, just so we can keep an eye on this, how it's playing out here. It's very similar, 50 below the 50 moving average on the monthly. It's probably going to test this 200 here. It's a bit of support around $80 or so. So we'll keep an eye on that. But again, the reason when I was calling BMO, I thought that there was a lot of issues with it. It was back up here when it was in this parallel channel. It was trading around, $94. Right now it's 83. So it's a bit of a move down. And if we look at the monthly on this too, again, we're below that 50 moving average, going to come down here. I think it's the weekly we have to look at. Yeah, there it is. That's the one I wanted. Death cross looming. Broke from that channel. And, as long as you keep closing these weeks below that 200 EMA, again, probably in 31 minutes, you're going to see another tick closer. The death cross could be playing in the next 2 weeks or so. Keep an eye on how this plays over the next few days. If anything bad comes out about banks in general, it's a good chance that a lot of these could see some negative price action that could just, by default, bring that death cross in a lot quicker than we're anticipating. So a lot of these banks, I don't know, not necessarily ones that I want to be, I would be cautious with a lot of these. That's what I'm saying. I'm not saying that any of them are bad. These are big banks. We know that they have a lot of deposits, but we have also seen Silicon Valley. We've seen First Republic. We've seen Signature, all banks with, whale banks with tons of money, tons of liquidity in them, just absolutely go pretty much poof, all the money went away. So we want to be careful. And then we also know that with the Canadian mortgage crisis, it's another problem for these banks, especially these international ones, right? There's a lot of shit going on. Assets are becoming debt. That's what you need to know. And that's going to, in turn, fuck with the stock price of a lot of these institutions. I do want to look up US Bank too, because that was one that reported yesterday that they've been having a bad quarter. I believe that they have over $500 billion worth of unrealized losses right now. And if I don't even know, is it USB? Yeah, US Bank Corp. Yeah, on the weekly, below the 50 moving average, death cross is already in, but on the monthly, You see that you're finding resistance on the 200 EMA. That monthly death cross is
A
very
lot of room
possible.
to the downside there too.
Yeah, and again, I'm Citigroup. I hate to be the fucking bearer of bad news, but we saw how much it went from the top to the bottom. We looked at this a long time ago, but here down to the low, it's about 98%. Just because it went 98% the last time doesn't mean that it can't go 98% again. It's kind of a crazy thing to say, but if we do see some issues with Citigroup, I wouldn't be surprised if we start seeing some of these percentages from the last recession play into this one, which is a very dangerous thing. Again, it's just a mentality thing. It's like if we sold off that much originally, even though it was $540 or so at the top of that market, it's very possible we can still test the same percentage if people think the same way. It might be a little bit less because there's a little bit more money in the markets, but we see how bad these banks are. We're seeing deposits go out. It means that there's a liquidity crunch. If there's a liquidity crunch, they're going to pull their money out of the stock market too if they do have any shares. So that's something we need to keep an eye on. That's it for the banks, I think, right now. I do want to look at crypto real quick just because, we got to talk about it before the week close. Major things to keep an eye on are Bitcoin. I'm still cautious. I think that they are holding up this market because they're trying to get out at better levels. And that's why we saw this push up. And again, look at that. Another bearish engulfing candle. It's like clockwork. They push the price up, they get out, comes down because no one's willing to buy it at that level. They're going to keep doing that. I also want to pull up this chart here, or this blue line, which I drew last night. Doesn't mean that it has to play out, but this blue line is pretty much support resistance that we have found every time we get to it. We get rejected hard there, went up to it, got rejected. Wouldn't be surprised if we tested one more time. It seems like it's lining up with the 200 EMA. 200 EMA is at 27K. If the price went up to the 27K, I don't necessarily think that it's going to stay there long. I think that we might get rejected, might break out above it for maybe a day or so, and then we can get right back into this trend line below it. And that could mean that we are going to start heading down closer to this 23. But there's a reason why 25.2 continues to be held. I think that people still are extremely overexposed in this market, and they're offloading. Nothing has changed with that thesis. I don't think that we're going up higher than 27K. If we do go up higher than 27K, if we say we go to 28.5, again, we talked about that would invalidate all this entirely, and then we'd be looking for different structures. But if we stay below this and we continue closing below this 200 EMA come Sunday, that 50 moving average is going to continue to cross, and we're going to get closer and closer to that death cross next week. I honestly believe that if everything stays the same, where it just pumps up and gets rejected right after, and it stays below the 200 EMA on the close, there's a good chance we could see the death cross sometime mid next week. And what happens next is it just would be our best guess. I would be honest. I think we'd go below this, probably down to 23.6.
What happened next?
I was trying to say it in a better way where I didn't use my catchphrase. Exactly. But yeah, it's not great, guys. And again, strong dollar. Dollar's kicking ass. And then if we look at this too, we were above it yesterday. Now we're below it. That green trend line or this green support line right here, still closing below it. We got the death cross on the total market cap. It's a matter of time. That's all I'll say. And again, head and shoulders pattern still hasn't broke from that too. That's due for a bit of a bigger drop here. So it isn't great because it isn't great, guys. That's all you need to know. I'm not telling you what to do with your money at all. Again, I have to say this. It's not fun to say it, but we have to say it because I am talking pretty negatively about a lot of things here. I'm just saying that there's a lot of things in the charts, in the news that are very negative, and I am not necessarily eating the shit that they're serving on Bloomberg, on Twitter, some bulls, or CNBC. I think it's worse than people expect.
All right. It is worse than people expect, and it's not great. That's going to wrap it up for today. Chris Hoddle with the side bet on when it goes below 1 trillion. Do you have within the next month, within the next 2 weeks?
I honestly think it's closer than people think. I'm serious. I think that's, let's be honest, next week is the 15-year anniversary of Lehman Brothers going under. We have a lot of shit data coming out next week. I don't anticipate CPI to be great. I think we're below 1 trillion within the next week or so. I'm not going to make a bet on it because I'm already trying to win this one Matic bet. I got to make sure I don't screw myself over, but I do think that we're very close to seeing negative price action, especially with that death cross on the total market cap.
Just so you know, I just looked up the 15-year anniversary. That's the crystal anniversary. Now, maybe, we get like some fake crystal or we get like a nice crystal Lehman Brothers engraved like cup, or if you're really in hard times, you get a little crystal meth. I don't know, but
Crystal meth, I like.
it is the crystal anniversary of Lehman Brothers collapsing, so we'll have
Trade naked on crystal
We're
meth.
gonna be out on Friday, but we'll celebrate it on Thursday. With the CPI and PPI, maybe we're gonna get a 15-year anniversary meltdown. Who knows? But that is going to wrap it up for today. Appreciate everybody who is here with us. We'll be back next week. It's going to be a fun one. We're going to have some new data. Interested to see what happens over the weekend. Yes, Ace, football is back. That is what is making this market more bearable. The fact that we are just going to be crab walking and it's just so boring is we got football back, and that's something else to bet on. And, I do, in fact, love that. So have a great weekend, everybody. Stay safe out there. Have some fun. Touch some grass. Enjoy this beautiful almost fall weather. And, we will be back. And, that's going to wrap it up for today. Oh, I knew I was forgetting. Buttons down below. Like, subscribe, comment, share us out. All that good stuff. We'll be back next week. Take care, everybody.
Take care, everyone. Have a good one.